Hi, everybody. My name is John Semankiewicz. I'm with Beer Law Center. I've got just a couple of seconds today to tell you a little bit about us. We're one of the sponsors and speakers here at the virtual conference. We're a small law firm based in Raleigh, North Carolina, and we have devoted our practice to alcohol producers and sellers, breweries, wineries, meaderies, cideries, kombucha, you name it, we've worked on it before. If you have a question, give us a call. We don't charge for initial consult, and if we don't have the answer, we'll help you find somebody who does. You can reach us at 919-335-5291. It's a telephone number. If you don't like that, just drop me an email at john@beerlawcenter.com, john@beerlawcenter.com, or find us on social media at Beer Law Center. We'd love to hear from you and we'll help you grow your business. Have a great day.
Hi, thanks for everyone who's tuning in. My name is Dave Oksenhorn. I'm a director at Marcum LLP. We're a national full-service public accounting firm. I'm in our R&D tax credits group, also a member of our food and beverage services group with a focus on craft breweries. And additionally, I'm a co-founder and co-owner of Two Havens Brewing Company based in Smithtown, New York. So going to be going over the research and development tax credit. Agenda-wise, going to keep it high level. Feel free to use the chat function if you want to put in any questions, and I'll do my best to answer them during the presentation or after, or at the end. My contact information will be up on screen, so feel free to reach out that way as well. So again, agenda-wise, going to go through a high-level overview of the R&D tax credit, give you a better understanding of the type of activities that are going to qualify for the credit, benefits of the credit, and then we're also going to discuss capitalization of those costs as it relates to research and experimental costs, which is a little bit different, but does encompass those items that are included in the R&D tax credit. And that's some new tax legislature that came out starting for the 22 tax year. I'll go into a little more detail in it in the upcoming slides. So as far as the overview of the credit, for anyone who's not familiar with it, it's available to companies that are going to be investing in other product development, formulations, recipes, new techniques. So it's very powerful for the craft beer industry because you're checking all those boxes when you're formulating new recipes for beers. Maybe you're improving upon your brewing process. All those different things go hand in hand. So we found it to be very powerful and yield some significant credits oftentimes. So the types of activities that are going to be eligible and those related expenses. So mentioned before, new brew recipe formulation. The first run of any new brews is going to be eligible there and qualifying. Also new process of brewing. Maybe you're doing some improvements. Maybe you're utilizing some new equipment where you haven't done that before. Not the training aspects of that, but the trial and error experimentation aspects. The three expense components of it that are going to qualify for the credit are going to be wages, supplies, and third-party contractors. So as it relates to the wages, the qualifying wages are going to be box 1 from the employee W-2s. So we can't include things like fringe benefits, 401k, or health insurances can be included in box 5 for the total wages. And then, as I mentioned before, training time isn't going to be eligible. So if you're training a new brewer on something, their time wouldn't be eligible there. But we're basically going to take and I'll go through a little later on about how it's calculated, but we're going to take a portion of those wages based on what those individuals are doing, the time spent on R&D. Supplies, that's going to go back to the supplies that are involved in a first run of a new production. 100% of the wages that we're qualifying are going to be eligible for the credit. That's going to go into our pool of expenses, and the same goes for our supplies. The third-party contractor expenses would include things like a consultant or possibly outside labor. Maybe you're having your beer contract brewed by someone, or you're utilizing someone for assisting in new formulations, new process development, or improvements. On the third-party contractor side, once we've figured out the amount that's allocated towards the R&D tax credit, only 65% of that is going to qualify into our pool of expenses. So when we get down to what qualifies as research for the credit, so we have our 3 buckets of expenses: wages, supplies, and third-party contractors. But in order for it to qualify for the credit, it has to pass what's called a 4-part test. 4-part test includes need to be technological in nature, have a permitted purpose, having an elimination of uncertainty, and a process of experimentation. So we'll go back to the first one, go through them all just briefly, just so you have an understanding what those mean. Technological in nature means it's got to rely on one of the sciences. In the essence of brewing, we're hitting the physical sciences, so we check the box there when we're brewing. Permitted purpose has to be an activity that's either working to develop a new product or possibly improve on a product or a process. Check the box there too when we're brewing new beers or potentially improving our brewing process. Elimination of uncertainty. We have to have uncertainty whether or not this is actually going to work. Always a potential issue where we're brewing that could be something that happens, makes the beer not desirable or meet expectations or the requirements we're looking for, or the same thing goes for a brewing process. And then finally, a process of experimentation. So trial and error experimentation. Each time we're brewing, we're doing some trial and error, maybe make some changes to it. Same thing goes for the brewing process. So then we get down to the calculation part of it. As I mentioned earlier, we got those three buckets: wages, supplies, and contractors. The calculation is going to be based on that pool of eligible expenses, meaning that we're going to take the percentage of time that our brewers and others that are involved, could be even people that aren't brewers, maybe on the marketing sales side that are in those meetings with you, determining new beers that you want to come out with. They may have a smaller portion of time allocated, but they may have some time. And those involved in packaging have time too, because they're involved in the packaging of those new beers, or possibly involved in other aspects of maybe making some enhancements to the process. So we take all those expenses, we allocate the percentage of time from the wages. We have our supplies that we've qualified as far as those first run brews, and then any contractor spend. And we get down to a pool of expenses. And then from there, generally the credit's going to come out anywhere from up to 7% under a simplified method, or up to 10% of a regular method. It won't go through those two more in-depth calculations, but you're looking at anywhere from 7 to 10% of those allocated qualifying expenses yielding a credit. So for easy math, let's say we've identified $100,000 of qualifying R&D expenses. We're looking at anywhere from a $7,000 to $10,000 federal R&D credit. The other thing to keep in mind is if you meet eligibility, you may be able to take a payroll tax credit as opposed to taking that against income tax. So the benefits of it are going to be if you're a pass-through entity, so an S corporation or LLC, the ultimate credit is going to pass through to the individuals on their Form K-1s. Then the individuals can then take that and offset personal income tax dollar for dollar. If you're set up as a C corporation, you're going to take that credit at the entity level to offset corporate income tax dollar for dollar. And that payroll tax credit election that I mentioned before, it's available for qualifying small businesses. Small business definition meaning you've been in existence 5 years or less, and you're under $5 million in annual gross receipts during that period. If that's the case for the 2022 tax year and prior, you can claim up to $250,000 of R&D tax credits against employer-paid FICA. And for 2023 and further, you can claim upwards of $500,000 of R&D tax credit per year. But the other thing to note is that you can carry forward. So let's say that you aren't eligible for the payroll tax credit, and you're having for the year you have a loss, you don't have any income tax to offset. You can carry that up to 20 years. So that's definitely helpful. We get the question a lot about going back. Can I go back to the last 3 open tax years and amend? And the answer is you can, but it isn't always the cost benefit of it may not be there anymore. And that the reason why is that because in 2022, the beginning of 2022, there was a new chief counsel memorandum that was put in place. It requires substantially more information that has to be provided with the return in the case of an amended return with a refund claim. So you need, in addition to doing the normal calculations, reporting on the forms, and then filing the amended returns, all things that are going to add obviously cost of compliance. Additional cost of compliance is going to require you to have substantially more documentation that's pulled together but then additionally reported and provided with the returns. So they're looking for what they call 5 items of information. This requires you to identify all business components to which the research claim relates to for each year. So whether that's new brews, new brewing process, whatever other items may qualify. And then for each of those, listing out each of the people who performed the activity and assigning the wages and all the information by business component. So it's a lot more in depth and a lot more documentation that's being provided. So unless it's a very, very sizable credit, often the additional cost of compliance for the amended tax return preparation, as well as other things, are just going to make it where it just doesn't make sense to continue on for that. Best practices, people always ask a question like, how can I make sure that we're optimizing the credit? Obviously, the information that we're getting is coming from you. So obviously having good records. So brewer's logs, tracking your new beers, tracking the brewer time or those involved in the brewing or new processes where possible. You can even, if you're tracking ingredients by brew, I know a lot of softwares will allow you to organize and keep that and maintain that for easier export for analysis and also compilation of the data. Some examples of that: Orchestrated Beer works very well, QuickBooks. So those are the different things that come into play there. So this seminar focuses primarily, or I should say, all on the federal R&D tax credit. But there are many states that follow similar rules, and you can get similar benefit there as well. Depending on the type of entity you are, whether or not, even though that state may have it at a corporate or C corporation level, there may not be a similar benefit for a pass-through entity, but there are many states that yield a similar benefit. So it definitely makes sense. On top of that, if you're taking the credit, to analyze the state side of it too. So we talked about all the benefits and the way that the credit's calculated, and obviously how powerful that can be. So additionally, I mentioned before about the new rule in place as it relates to amended returns effective January 1st of 2022. Additionally, effective January of 2022, we had new rules in place as it relates to capitalization of costs. So the way it used to work, we have our wages, we have our supplies, we have our contractor spend. We had the option of either deducting those in full, so we're just going to expense it as incurred on our tax return, or we could capitalize and amortize it. Most people were always taking the option of just deducting it as incurred. Obviously, that's the more favorable treatment to take. We get that expenses up front, take those losses right away if we have any, and if we had any even carry forward losses, we just carry that forward. So most people weren't really opting to do that. However, in 2017, there was a provision put in place by the Tax Cuts and Jobs Act requiring that these costs be capitalized, and meaning they had to be amortized. And this was effective January 1st of 2022. So what does that mean? That means that we can't immediately deduct these expenses. If for most of the brewers, we don't have costs overseas, meaning we're not using people overseas to brew the beer necessarily. If we were, those costs would be amortized over a 15-year period. But most of us have all of our activity in the U.S., meaning that we're going to have to amortize that over a 5-year period. And this is all a midpoint or mid-year convention, meaning that we only get a half year of amortization. So go back, use some easy math again. In our example from before, when we had the $100,000 of R&D expenses, we're taking that $100,000 over a 5-year period, but a mid-year for year one, then we're only getting 10% or $10,000 as a deduction, meaning we have $90,000 remaining to amortize over the 5-year period. So it's not a loss deduction. It's not something where it's no longer tax deductible, like 50% of meals or officer life insurance or something else that's completely not deductible. So it's a timing difference. Think of it similar to if you have a capital asset or a fixed asset like equipment, where you may not be able to fully depreciate it in year one and you're depreciating it over the remaining life for tax purposes, you're going to have a similar thing here. The other thing just to keep in mind, God forbid, obviously, you say, hey, we're not brewing anymore and we're shifting out of the business and whatever else may be, we still have to keep amortizing that, even if that aspect, or even if you had a specialized project, let's say for 1 year we did a ton of R&D, we went away from that, you got to keep amortizing it until you reach the final 5 years. You can't just say, hey, we had a real big special project and we've captured all these costs, amortizing it, and it's no longer, so we're going to try and dispose, retire, abandon it. That we can't do. So I mentioned before about what's captured for the R&D tax credit. So that's covered under Section 41 in the Internal Revenue Code. The capitalization aspects are considered research and experimental costs, and those are under Section 174. So it's a little bit different. It's actually more expansive than what's included in Section 41, meaning that it's going to include all the costs that are incidental into us kind of eliminating that uncertainty. So it could include things that we couldn't capture before. As I mentioned before, the wages for the credit are only going to be box one. We're not going to include any of those fringe benefits, whereas 174, this capitalization rules, is going to take an allocable portion of those overhead costs. So fringe benefits, rent for the brew house, utilities, and other things that are going into play as it relates to research and experimentation, but aren't included for the credit. The other thing to keep in mind too, which is even more expansive, is on the contractor side, where I mentioned only 65% of those contractor fees, if we have any that are related to R&D, are going to be utilized in the credit. Under 174, when we add those back, it's 100% of whatever we've qualified. So let's say we had $100,000 of allocated contractor R&D that we identified. For the credit, we're only getting $65,000 of that into our pool of expenses. Whereas under the 174 of the capitalization rules, we have to pick up the whole 100. So just to kind of go back and kind of make this a little easier to understand. So we have $100,000 R&D expenses. We're going to get anywhere from $7,000 to $10,000 of a federal R&D credit, offset either corporate income tax or personal income tax if it's a passive entity. Capitalization aspect of it, we have the $100,000. We start with what we've identified under Section 41 for the R&D tax credit, but on top of that, we have to add on all these other items, allocable rent, the fringe benefits. So it could be anywhere from like maybe another 30 or even 50% on top of that we could have on top potentially, depending on how, what's allocated. It could even be more than that. So we could be anywhere from $150,000 to $200,000 of items that we can no longer expense in year one. We only get 10% deduction. So $15,000 to $20,000 deduction of that $150,000 to $200,000, as opposed to taking that all in year one. So obviously it's very punitive. It's definitely not the good news part of this presentation. The other bad news part of it, and again, this was in place as of January 1st of 2022. So any identified R&D, this would have come into play for the 2022 tax year as well already. Bad news part about it too is a lot of people ask the question, well, I've taken the R&D tax credit before, or we've looked and we see we have something here. Look, but let's just not take the credit. Let's just forego the credit. We want it to capitalize. We'll just expense everything. Obviously, we'll miss out on the benefit of the credit in addition to those deductions we'll get over time. But let's just disregard that. The rules state that you have to capitalize regardless. So obviously, it's in your best interest. Take the credit. Helps offset any tax you may have. And then obviously after the 5-year period, because again, it's a timing issue, you're going to get those expenses in full 100%. And on top of that, you're going to get the credit each year, whatever that may be. So in the end, you're ahead of the game. Obviously, it's a timing issue, but that's the best part of it, at least, where you have the credit on top of having these capitalized costs. As I mentioned before, obviously these have to be capitalized, amortized mid-year conventions. We're only getting 10% of those costs for the U.S. costs for year one, and then being more expansive because it's going to be inclusive under Section 174, a lot broader than those that are just for the credit. So we go into some of the legislature because people ask the question, well, is this going to go away at all? This is obviously unfavorable. I think that there wasn't really an idea that this was going to come to be. As I mentioned before, this was put in place 2017 to take effect in 2022. Obviously, everything that went down, COVID, all the other money out, obviously they're looking for revenue. So this stayed in place where I think years ago there was no real thought that this was necessarily going to go through. Again, I don't know this for sure, but I think that's kind of the general idea. But that being said, obviously, anyone who's pro-business, they've been trying to put through bills to either repeal this or defer it. So the first tax bill that came out that was proposed last year in 2023 was the American Innovation and Jobs Act. So this one came out in March of 2023. It was proposed by the Senate. It was introduced, but it just unfortunately never went any further than that. This one was going to have a full repeal of those capitalization rules, meaning we could just go back and just expense it the way it was. And then additionally, they were looking to enhance that R&D credit to make it more beneficial to startups and small businesses. So I mentioned before about if you're considered a small business, so you're 5 years or less in existence, under $5 million in gross receipts, taking that payroll tax credit, meaning that if you're not profitable, let's just say we had a loss and we're like, you know what, we can't use this credit. We don't know. We probably got a handful of years till we show profit because we got depreciation for our brew house, whatever it may be. And we're kind of still ramping up. We can at least take the credit against payroll tax, employer paid payroll tax, get us monetization of the credit up front. So this bill was looking to double that, going from that what I originally spoke about before for the 2022 tax year, $250,000 of credit being able to utilize against the payroll tax, all the way up to $500,000, and then ultimately to $750,000 over a 10-year period. Furthermore, they were looking to expand those thresholds. So whereas it was 5 years in existence and $5 million of gross receipts, they're looking to expand that further to $15 million in gross receipts and up to 8 years. And then a period of 8 years starting after generating at least $25,000 in revenues, as opposed to just hitting that threshold in one of the years. So unfortunately, no movement on that. And we haven't seen anything, we're already into a year later and still haven't seen anything. It doesn't appear that anything's going to move forward on that bill, unfortunately. Next bill that came out was just a month later, April of 23. This one proposed by the House of Representatives. Again, introduced. Unfortunately, no movement on that. This one looking for a full repeal of the capitalization requirements. And both of them, I should say, would been in place beginning after December 31st, 21. So it would have covered the 2022 tax year. But unfortunately, no movement on that. So flash forward to June of last year and yet another bill, unfortunately introduced, but no movement. This was the Build in America Act. This one was going to retroactively suspend the 174 rules. So basically defer it until after 12/31/25. So it would start for the 26 tax year and be effective after December 31st, 21. So obviously getting into June at this point, we're already so far into the tax year that a lot of people had filed tax returns and had to adhere to these rules. So then making it retroactive, putting in play what they call transition rules, meaning that we could either amend 2022 to expense what we had capitalized, or just take it and make an accounting method change in the tax year 2023 and expense it all there. So we just have more deductions in that year. So again, no movement on this one. We're not quite a year past this one, but we haven't seen anything. The recommendation to most, if this were to pass, excuse me, would have been to expense it in the 2023 tax year, just take it all then, as opposed to amending, just because the amended tax return process, one, is going to incur additional costs of compliance. Obviously, you got to prepare those returns. But two, the amended tax return process is extremely long just to get it through the IRS. And if you're filing state amended returns as well, especially if you're doing it for both business and personal. So you're waiting all that time for it to be processed. You're waiting longer for it to be refunded. Any balances due to you. So a recommendation would have been to file that 2023 tax return, make that accounting method change, and then just expense it all there. as opposed to going back and amending. And then more recently, only a couple months ago, we had a glimmer of hope here, the Tax Relief for American Families and Workers Act of 2024. This one introduced in January of 24, and introduced and was passed in the House actually pretty quickly. So we were hopeful that this was going to move forward to the Senate, they would vote it through, and that this would go through. But unfortunately, there's been no movement as of now. And as we get further into the tax season, the tax filing season, that is, we're unsure if this is really going to move forward either. This one was similar to one of the other bills, retroactive suspension. So not a full repeal where they've eliminated the capitalization altogether, but they've deferred that same period of time, retroactively deferred it. So effective for years after December 31st, 21. So meaning the 2022 tax years filed in there all the way through December 31st of 2025. So same idea here that there was available, go back and amend, or file, just close all out with the 2023 tax year. So I guess the other things that I get, and obviously, and I'll put up my contact information towards the end. Should anyone have questions, feel free to reach out to me. A lot of people ask the question about what kind of documentation and record keeping requirements do I have in order to support a claim. So, and part of that depends. I mean, it depends on the size of the credit, of how much we need to support, whether or not we have like a full study report, as we call it, that's going to have like a full documentation of major activities that went on during the year, or just a calculation report. But obviously you want to keep anything that you have on your end, regardless, of the size of the credit and what we're doing, just to make sure you can substantiate it. So if you have any brewer's logs or anything that you're using to come back with the amount of time spent, the ingredients that you've pulled, you should have some kind of record keeping there to support that. And as far as risk is concerned, timely filed returns usually have the least amount of risk versus going back and amending. But obviously you always want to make sure you have something to substantiate it. So, whatever is being provided, you want to make sure that you keep that in your records. The other thing too, people ask the question about how do you determine what's eligible to claim. Some of these things may come into play that you may put together employee time survey, figure out like how much time your employees spent on R&D activities, and then just discussions with key people that are working just to figure out determining time spent. So this could be other things too, like manufacturing logs or other areas that you've kept. Contact information is here. I don't see any questions currently, but please feel free to reach out to me. My email address is there, as well as my phone number. So I appreciate the time. And again, please reach out if you have any questions.